The IMF just dropped a major warning, and it exposes how fast the United States is losing global financial control. According to the fund, more countries are now walking away from the US dollar and shifting toward China's yuan. And the numbers backing this shift are enormous. In the first 9 months of this year alone, China expanded its loan capacity by over $2 trillion. That kind of financial firepower is pulling nations directly into Beijing's orbit, and Washington knows it. The truth is simple. The global economy no longer trusts the US the way it used to. Years of trade wars, tariff battles, and political unpredictability have shaken confidence in the dollar. Meanwhile, China is stepping in with cheaper loans, easier terms, and a fast-growing financial system that operates outside US control. Countries want stability, and Beijing is offering it. That's why the IMF is sounding the alarm. So if you've been wondering how this shift started and how far it can go, stick around, subscribe, and let's break down how China is pushing the US dollar toward its biggest crisis yet. We're looking at numbers that should raise alarms, because they show just how quickly the US dollar is losing ground. According to the People's Bank of China, new yuan-denominated loans hit almost 15 trillion yuan in the first 10 months of 2025. Roughly $2.1 trillion. One country injecting over $2 trillion into global credit isn't normal. It's a calculated strategy, and this strategy didn't come out of nowhere. China's domestic economy is under pressure from a slowing property sector, weak exports, and softer global demand. Beijing's answer has been aggressive credit expansion. But not just inside the country, China is using this lending power to push the yuan outward, ensuring that domestic stimulus also strengthens global influence. Every new credit line, swap agreement, and offshore loan kills two birds at once. It supports China's economy and undermines the dollar. A big part of this expansion is the PBOC's growing network of currency swap lines. These agreements allow foreign central banks to borrow yuan directly from China, bypassing the dollar entirely. What looks like financial cooperation is actually geopolitical leverage. Countries tied into yuan liquidity become dependent on China for economic stability and less dependent on Washington. We're already seeing how this plays out across the developing world. At the CELAC-China Forum in May 2025, Xi Jinping announced a 66 billion yuan credit line for Latin America. Fully denominated in yuan, China also committed to more than 100 joint projects in infrastructure, energy, and digital technology. These deals don't just fund development, they anchor entire economies inside a yuan-based system. Infrastructure gives China even more long-term influence. A CSIS report shows Chinese companies now operate or invest in 31 ports across Latin America and the Caribbean, many positioned on strategic maritime routes. Control of ports translates into control of supply chains, and ultimately, political leverage. China's offshore financing markets are expanding as well. Dim sum bonds, yuan-denominated bonds issued outside mainland China, have surged, giving foreign companies and governments a way to raise capital directly in yuan. This kind of financial architecture simply didn't exist 20 years ago. Meanwhile, US lending power is shrinking under the weight of high interest rates. Developing nations can no longer afford dollar borrowing when treasury yields are elevated, making China's lower-cost yuan loans even more attractive. Even major economies in the region are shifting. Argentina expanded its 5 billion yuan swap line with China, gaining the ability to borrow and transact directly in yuan instead of dollars. Moves like this pull countries out of Washington's orbit and deeper into Beijing's. For the United States, this is dangerous territory. Latin America has long been its economic and political backyard. But as more countries borrow in yuan, build with Chinese funding, and integrate Chinese infrastructure, they move away from dollar-centric systems and toward China's yuan. And that shift is exactly what forces Washington, and the Trump administration specifically, to scramble for a response. When you look at what's happening in Argentina, you see a US move designed to counter China. But the facts reveal a very different story. The Scott Bessent-led Treasury agreed to a $20 billion currency swap line with Argentina under Javier Milei, a close Trump ally. On paper, it looks like Washington reasserting influence in a region China has been steadily pulling closer. But in practice, the US is stepping into an environment where China already dominates the financial and trade landscape. Argentina remains deeply tied to Beijing despite Washington's sudden support. Trade with China is accelerating, not slowing. After Argentina cut export tariffs, for instance, China purchased about 7 million tons of Argentine soybeans. A huge relief for Buenos Aires, but a direct hit to U.S. farmers who are shut out of that same market. For them, it looks like Washington is pouring billions into a country that is actively strengthening its relationship with China. The financial picture is no less contradictory. Although the U.S. insists this is a swap line and not a bailout, the effect is almost identical. U.S. banks are discussing an additional $20 billion in loans, pushing potential support to nearly $40 billion. And yet Argentina continues expanding yuan-based swap lines, signing Chinese-denominated deals, and deepening its economic alignment with Beijing. This is where the irony becomes impossible to ignore. While American farmers lose access to China's agricultural market, the U.S. is simultaneously helping Argentina secure more of it. Washington is spending billions to keep Argentina close, but Argentina is using that breathing room to move further into China's financial system. In the end, the contrast is brutal. The U.S. is investing billions to keep a strategic partner in its orbit, and that partner is drifting toward China anyway. China is no longer just competing through trade or investment. It is rebuilding the financial infrastructure that global markets rely on, and doing it in a way that sidelines the U.S. dollar. Over the past 5 years, external renminbi lending, deposits, and bond activity by Chinese banks have quadrupled to more than 3.4 trillion renminbi, or about $480 billion. This isn't normal credit expansion. It's China designing financial plumbing that works outside the dollar-based system. One of the key tools behind this shift is CELAC-China, China's cross-border interbank payment system. It's not as large as SWIFT, but it is growing fast, processing trillions in annual settlements and giving countries a way to transact directly in yuan. For nations hit by sanctions, dollar shortages, or high U.S. borrowing costs, having an alternative is powerful. This new infrastructure is already reshaping global trade. More oil, gas, metals, and agricultural goods are being settled in yuan, especially after China and Russia expanded their yuan-based energy trade. Brazil and China have also formalized yuan settlements for major commodities like soybeans and iron ore, allowing billions in trade to bypass the dollar entirely. The statistical trend is undeniable. The yuan's role in global trade finance has surged, recently overtaking the euro to become the world's second most used currency in trade settlement. And its weight inside the IMF special drawing rights basket has gradually increased, reflecting a growing international acceptance of the yuan as a long-term reserve asset. Meanwhile, China is pushing its digital yuan across borders. Several ASEAN and Middle Eastern countries have tested cross-border payments using digital yuan rails, with lower fees and faster clearing than traditional systems. For developing economies, that's a practical reason to reduce reliance on dollar infrastructure. As this ecosystem grows, the effects spread quickly. Countries that once defaulted to dollar borrowing are shifting parts of their debt into yuan because it's cheaper and easier to service. Kenya, Sri Lanka, and others have already started converting or issuing debt in yuan. Even U.S.-aligned nations in Latin America are exploring Chinese financing through BRICS institutions instead of Western lenders. This is the real shift. Every yuan loan, swap line, or settlement makes the dollar less essential. China isn't just promoting its currency, it's replacing the foundations of the dollar-led system with something new. Donald Trump is now sounding the alarm. He warned that the United States could face an economic and national security disaster if the Supreme Court ruled against his tariffs. What he's really acknowledging is the erosion of America's financial leverage. The system that kept the dollar dominant for decades is no longer stable, and global trust is slipping. It's important to see how this unfolded. Trump used emergency powers under the International Emergency Economic Powers Act to impose sweeping tariffs on nearly every major trading partner. The scale and unpredictability of those actions rattled global markets. Countries began questioning whether they could rely on the dollar when U.S. trade policy seemed to shift overnight. Even the Supreme Court signaled that the legal authority behind these tariffs might be stretched too far. Inside the U.S., that uncertainty hits the financial core. Investors who once saw U.S. Treasuries as an unquestioned safe haven are now weighing the risks of a country that is more isolated in trade and more volatile in economic policy. When trust weakens, the dollar's advantage weakens with it. Demand for treasuries can fall, borrowing costs can rise, and the U.S. loses the automatic power it once held. While the U.S. stumbled through this self-inflicted instability, China took the opposite approach. It expanded currency swap lines, increased yuan-denominated financing, and deepened partnerships with countries eager for predictable alternatives. China didn't need flashy announcements. It simply built a parallel system and let frustrated nations walk into it. The result is becoming clear. More countries are operating in yuan, fewer are relying on dollars, and that shift is exactly what triggered the IMF's warning. The IMF's latest warning sounds urgent, but it also reveals how desperate the situation has become. Publicly, the fund is urging countries to be cautious about shifting toward the yuan, insisting that any move away from the dollar must fit medium-term debt and reserve management strategies. It's a clear attempt to preserve the dollar's central role in global finance. But behind that message, the real transformation is already underway. Around the world, central banks are quietly reshaping their reserves, and the IMF knows it. Data across 2025 shows a decisive trend. Central banks expect to increase their gold holdings and reduce their share of dollar-denominated assets. According to the World Gold Council, 76% of central banks plan to add more gold over the next 5 years, while 73% expect their dollar reserves to shrink. These aren't symbolic adjustments. They're signals that global institutions see the dollar's long-term stability as increasingly uncertain. And then comes the most revealing shift of all. For the first time in decades, central banks now hold more gold than U.S. Treasuries. That single milestone shows how dramatically global confidence has changed, and why the IMF is on edge. Countries aren't just weighing yuan versus dollars. They're moving into assets that avoid dependence on any major currency altogether. From Washington's perspective, this dual trend is dangerous. While the IMF discourages rapid moves toward the yuan to protect the dollar's dominance, central banks are already acting on a different assessment. They're broadening their reserves, buying gold, and tapping new financial frameworks that reduce reliance on the United States. The system the IMF is trying to defend is slipping, even as it warns the world not to let go. But here's the real question. If the world is already preparing for a post-dollar future, is the United States ready for what comes next? Or is it already too late? If you want to follow how these shifts reshape global power and what China is planning next, make sure you're subscribed. See you in the next one.